Welcome to the Deep Dive. Today we're digging into Broadcom's Q3 fiscal 2025 results. And wow, these numbers weren't just good, they really blew past expectations.
Absolutely. A really strong quarter, driven heavily by AI, as you might expect. But there's more to it than just that.
Right, it looks like AI is the turbocharger, but there are other currents too. We should probably unpack that. What's really driving this, and is their AI strategy, truly dominant?
That's the key question. We need to look at what fueled this performance, especially their custom silicon, the XPUs, and their networking strategy, and also what management's signaling for the future.
Okay, let's hit the highlights first. Total revenue, a record $16 billion for Q3. That's up 22% year over year.
Yeah, strong top line. And profitability was impressive too. Non-GAAP EPS came in at $1.69.
Which beat the street, right?
Comfortably beat consensus, yeah. And their operational efficiency, that really stood out. Adjusted EBITDA had a record $10.7 billion.
$10.7 billion. That's a huge number.
It is. And they maintained a 67% margin there, which shows really disciplined management.
And cash flow.
Also very strong. Free cash flow was $7.0 billion. That's about 44% revenue. Shows they're really good at turning sales into actual cash.
Okay, so where did that $16 billion come from? Let's break it down. AI semiconductor revenue seems like the star.
Definitely. $5.2 billion there, up a massive 63% year over year.
63%. And that's continuing a trend, isn't it?
It is. That's 10 quarters straight of growth in AI revenue. Just incredible momentum.
And the software side. Infrastructure software.
Also solid, $6.8 billion. That was up 17% year over year and actually came in above their own outlook.
So strong performance across the board, but clearly AI is leading the charge.
No doubt. And the market noticed. Stock was up after hours. Signals confidence, not just in the numbers, but in their forward guidance too.
Okay, let's dive deeper into that AI story then, because it's clearly central. Their XPU business, the custom AI accelerators, that's a big piece of this.
It's huge. It's now 65% of their total AI revenue. They talked about their 3 existing customers, these hyperscalers, on a, quote, compute self-sufficiency journey.
Meaning they're building their own custom AI stacks.
Exactly, from the silicon up. And Broadcom's positioning themselves as the key partner for the custom chip part, gaining share progressively.
Okay, but the really big news was the new customer.
Oh, yeah. That was the headline grabber. A 4th qualified customer for XPUs. This was one of the prospects they had mentioned before.
And the order size?
Over $10 billion. In AI rack orders, slated to ship significantly in fiscal year 2026.
Wow, over $10 billion from one new customer.
Yeah, it's massive. And what it means is their AI revenue growth for FY26 is likely going to accelerate beyond the 50-60% year-on-year growth they were previously talking about.
So this materially lifts their FY26 outlook.
Correct. It's a fundamental change in the trajectory. And they still mentioned having 3 other prospects they're talking to, so potentially 7 big custom chip customers in total.
But they're being selective.
Very. They said they're very picky and careful about who they qualify. These are deep, long-term partnerships, not just selling chips off the shelf.
So what's the long game here with these XPUs? They think custom chips will overtake GPUs for these customers.
That's the bet. For these specific large-scale hyperscalers, yes. Management believes XPU share will eventually surpass GPU share.
Why?
Because it's a multi-year journey. As the customers get more confident, as their software stacks stabilize around these custom chips, the total cost of ownership benefits become really compelling compared to general-purpose GPUs.
That assumes the software part gets sorted out smoothly, though.
It does. That's the challenge. NVIDIA obviously has a huge lead on the software ecosystem side, but Broadcom's aiming for that million-unit goal for current customers, and this new $10 billion order really backs up that ambition.
Okay, so custom chips are one pillar. What about getting all those chips to talk to each other? Networking seems critical, especially as these AI models get better.
Absolutely critical. You've got these massive compute clusters, sometimes over 100,000 nodes. The network is the bottleneck if you don't get it right.
And this is where Broadcom's Ethernet experience comes in.
Exactly. 20 years of it. They're making a really aggressive push for Ethernet to be the standard for AI fabrics, even going head-to-head with InfiniBand on latency.
How are they doing that? What products did they highlight?
They talked about 3 key ones addressing different scaling challenges. First, Tomahawk 5.
Okay.
That's for scale-up, making things faster within a single compute rack. They use Open Ethernet to connect up to 512 compute nodes together, which is way more than typical proprietary links for GPUs.
512 nodes in one unit. That's a lot.
It is. Then there's Tomahawk 6. That's for scale out, connecting across multiple racks. It's a 102 terabit per second switch.
102 terabits.
Yeah. And it flattens the network design to just 2 tiers, which cuts down latency and power. Think fewer hops for the data.
Got it. And the third one?
That's Jericho 4. This is their next-gen fabric router for scale across, connecting massive clusters, even across different data centers.
So like superclusters.
Yeah, beyond 200,000 nodes. It has deep buffering, intelligent congestion control. Basically, it's designed for the absolute largest AI infrastructures spanning geographies.
So the takeaway is they want Ethernet to be the universal standard for AI networking.
Pretty much. Open, proven, scalable. And they believe they can make it perform as well as or better than proprietary solutions like InfiniBand, even for the most demanding tasks. It's a bold play to own the whole AI data center fabric.
Let's switch gears to software. VMware. How does that fit into this AI picture?
It's a surprisingly big part of it, actually. Infrastructure software revenue was strong, $6.8 billion, beating their outlook, and they booked over $8.4 billion in total contract value just in Q3.
What was the big news there?
The release of VMware Cloud Foundation, VCF version 9.0, this took 2 years, 5,000 developers. It's their fully integrated private cloud platform.
Letting enterprises run everything, including AI, on-prem, or hybrid.
Exactly, a real alternative to just going all in on public cloud. And they said over 90% of their top 10,000 VMware accounts have already bought VCF licenses.
That's huge adoption already.
It is. So the focus now is helping them deploy it, get it running well. The idea is this leads to bigger private cloud footprints, and then selling more services on top security, disaster recovery, and crucially, support for AI workloads running on VCF.
Interesting. And they made a point about not cross-selling Broadcom hardware with VMware?
Yeah. They were clear. The virtualization strategy is about commoditizing the underlying hardware. They want VCF to be the essential software layer, no matter whose servers or chips are underneath. It's purely a software play.
Okay, so AI and software look strong. But what about the rest of the semiconductor business, the non-AI parts?
Right, that's the other side of the coin. Non-AI semiconductor revenue was $4 billion in Q3. That was flat sequentially. So some softness there.
Where did the softness come from?
Well, broadband actually showed good sequential growth, but enterprise networking and server storage were down. Wireless and industrial were pretty much flat.
So not a broad recovery yet in those traditional markets.
Not really. And for Q4, they're guiding non-AI to grow sequentially, maybe low double digits, to around $4.6 billion.
What's driving that expected Q4 bump?
Mostly seasonality. Things like broadband, server storage, wireless usually pick up a bit, but they expect enterprise networking to stay down.
So management isn't calling for a quick snapback, a V-shaped recovery in non-AI.
No, definitely not. They explicitly talked about a U-shaped recovery, meaning they don't expect things to really improve meaningfully until maybe mid to late 2026.
Mid to late 2026. That's quite a ways out.
It is. It implies these broader macro issues and inventory corrections are sticking around. But on the positive side, non-AI bookings were actually up over 20% year on year. So maybe some light at the end of the tunnel, but it's a long tunnel.
Okay, let's look at the overall guidance then. Q4 outlook.
It looks strong overall thanks to AI. They're guiding consolidated revenue to about $17.4 billion.
Which is up.
Up 24% year over year. And the AI semiconductor piece of that is guided to $6.2 billion for Q4.
That's up 66% year over year for AI chips, just accelerating.
Absolutely. And they expect adjusted EBITDA margin to hold steady at 67%. So continued profitability discipline even with that growth.
And the backlog. You mentioned that earlier.
Hit a record, over $110 billion consolidated backlog. At least half of that is semiconductors. Gives them huge visibility.
Plus, the CEO, Hock Tan, confirmed he's staying on.
Yeah, through at least 2030. That signals stability and continuity in leadership, which investors generally like to see.
So the core strategy seems to be ride the AI wave with custom chips and networking, integrate VMware successfully, and manage the non-AI parts through this slower U-shaped recovery, all while keeping margins high.
That sums it up pretty well. AI scale plus operational discipline.
How did the market ultimately digest all this? You said the stock was up.
It was. It was seen as a classic beat and raise. Strong results, strong guidance, especially that new $10 billion AI order providing multi-year visibility.
But maybe not a total blowout reaction compared to some expectations.
Right. I mean, expectations were pretty high going in, so positive reaction, yes, definitely. But perhaps tempered slightly by that acknowledged softness in the non-AI segments. Investors are clearly thrilled with the AI story, but they're also keeping an eye on the rest of the business.
And competitively. How do they see themselves versus, say, NVIDIA?
They position themselves as winning through deep custom partnerships and superior foundational tech like SerDes and packaging for XPUs. On networking, they seem confident Ethernet's openness will win out for hyperscalers in the long run. They almost welcome competition there, saying it helps the customer.
Okay, interesting positioning. Right, let's move to our favorite segment.
The "this is not financial advice" segment. Time to get speculative.
Okay, based on everything we've just heard, the accelerating AI growth, that huge new XPU order landing in FY26, the Ethernet conviction, VMware stability, what's an outrageous but plausible trade idea?
All right, here's one for the adventurous. Given that acceleration into FY26, driven by that $10 billion customer ramp plus the existing ones, and adding in the potential for a late tailwind from the non-AI U-shaped recovery finally turning up.
Okay.
How about a bull call spread on Broadcom, ticker AVGO, but targeting an FY26 expiration?
A bull call spread. So buying a call option near the current price and selling another call option further out higher up.
Exactly. You buy a call, let's say at the money, expiring maybe December 2026, and you sell a call, same expiration, but with the strike price significantly higher.
Define significantly higher. What's the outrageous part?
Let's say you set that short call strike at a price implying another 30% upside from current levels by December 2026.
30% higher for the short strike. Okay, that's ambitious.
It is. It's leveraging the idea that the AI revenue accelerates even faster than the already raised guidance, thanks to that $10 billion order really hitting its stride in Q3 FY26. Plus, you get that non-AI recovery kicker later on.
So the strategy captures big upside if they execute perfectly on that very high AI bar they've set.
Yeah.
But it also caps your potential profit and defines your risk because you sold that higher call.
Precisely. It's a defined risk bet on Broadcom nailing that accelerated FY26 AI trajectory, banking on continued momentum in custom silicon and networking leadership. It acknowledges the high bar, but bets they clear it.
Got it. A leveraged bet on continued AI dominance and execution into FY26 definitely fits the outrageous but plausible category. Okay, that wraps up our deep dive into Broadcom's Q3 FY25 earnings. The big themes seem pretty clear.
Yeah, AI is firmly in the driver's seat. Custom accelerators, networking, that's the engine. And VMware is providing this really stable, expanding software base.
Well, the non-AI parts navigate that slower U-shaped path.
Right. But the overall picture is strong momentum, especially where it counts in that high-value AI infrastructure space.
We hope this gave you a solid overview. As always, do your own homework. Maybe think about whether this mix of custom AI, networking, and software is truly a sustainable advantage for Broadcom.
Or how much risk that non-AI slowdown poses. And remember, none of what we discussed, especially that last segment, is financial advice. It's purely for informational and discussion purposes.
Thanks for tuning into the deep dive. We'll catch you next time.